In this video, I want to share with you how to grow your account the right way, and the right way to think about it, regardless of your account size, whether you've got a small account, large account. But a lot of people, when they're starting out, they got a small account, and that I find is the biggest struggle. So I spend a lot more time dealing with people who are just getting started. So anyways, in this episode, I'm going to share with you how to grow a small account, thinking about your portfolio the right way. Let's take a look. All right, so what a lot of people do when they look at growing an account, they basically put all their eggs in one basket. And I'll say, you got this basket right here. Here's your money. Let's just say it's $10,000. What they do is they start day trading with this account, and they might go in and say they put a load in on one stock. So this is stock number 1. And they might put in, like $8,000 in this stock. But the problem is now you're getting a huge drawdown. When anything bad happens, you're concentrating a lot of the risk is right there in that single stock or that single area. Yes, I understand that probably the results of that trade or investment, whether you're doing day trading, swing trading, whatever the case is, maybe you're making $200 on it. Maybe you're making, let's say, $700 on it. The fact is you're probably not making a lot because you got to put a lot into it to be able to grow that account. However, the problem here, what you really realize is the lack of capital actually is what hurts a lot of traders, because now they are actually trading the incorrect way and investing the incorrect way. It's managing a portfolio a bad way, because now if anything happens, like let's say you get into this stock, and we'll just look at just standard deviation curves. Let's say you get into this stock at about $300 a share, or even let's say $30 a share, whatever the case is, doesn't matter. If this stock now just goes down on you to a level that you didn't expect, right? Outside of your range, outside of your comfort zone, now this whole position's in trouble. So you basically got 8,000 invested, and that can take your account down. It could take it down by, $4,000. It could cut your account almost in half from that $10,000 account. So you need to be very, very careful and mindful of what's going on and what's happening in these kinds of situations. Even though you say, hey, I'm going to have a stop, but the stops, they can get blown out. It can happen. So be very careful. Instead, the smart approach, look, think of it like a store. A store, what it has is it has multiple products. You might have fish, you might have rice, you might have milk and dairy, and you've got, let's say, fruit, and all these areas that you have these different products. They might make, let's say, 20% on this. They might make 10% on this. They might make 15% on this. So they're making, different percentages from each area or industry. But let's say this category, let's say the fish just doesn't come in and starts rotting. Well, now maybe they don't make as much money or income or revenue. If the percentages confuse you, just change this to 1,000, change this to 2,000, of income level per month or something like that, or profits. And the point is you've got money coming in from all sorts of areas. So that way, if any one thing goes bad, you're okay. So when you're dealing with a small account, you have to look at it from different pillars or different areas. So let's say I've got this segment where now I am actually making money from day trading. Okay, so this part, I'm going to go ahead, and even if you've got a $10,000 account, you might say, okay, well, let me put in my day trading area, I'm going to put in, like, let's say $2,000. So that's the most capital I'll ever use in day trading. Then you might say, okay, well, I'll go ahead and also have some swing trades, or iron condors, or option trading. So what you're doing is, if you're doing day trading and that's all you kind of know, that's fine. That's the starting point. But what you want to do is start allocating your capital in different spots. So now you can start doing like some option trades. And if you're interested in options, by the way, you could definitely check out my website and other channel for options trading. So you could go into the options trading. So let's say you've got verticals or singles that you're trading. Then what you could also do is, let's say you got some stuff in dividend investing. So here we go. We got dividend stocks. So now you've got like 3 different areas. I've got day trading, I've got option trading, I've got dividend investing. So this way, if anything goes down, let's say for the day I just do bad, well, maybe I just blow that part of my portfolio. Or option trading isn't going well, I have the other parts. So you're just trying to allocate capital in different ways. It's the same thing like if you're doing like, let's say, real estate, or you have investments in other areas. What you're trying to do is just be more and more diversified. The more places you can have your money, the better off diversified you are. And with a small account, it's very difficult to understand this, and it's very difficult to diversify. So what you do need to do is kind of draw down to like 1 or 2 of these, but understand that you're concentrating your risk very heavily. And that way, when you get a movement against you, it's really unfortunate. It's much more difficult to grow a smaller account than managing or dealing with a larger account, even though you have to be more diversified, because your mistakes, you can't make as many mistakes with a smaller trading account. But with a larger account, what you could do is start spreading your capital and sprinkling your cash all over the place, right? If you look at the famous actors and actresses, they got their money here, they got their money here, they got their money here. It might be in fancy cars, it might be in portraits or paintings, famous things. It might be in stocks. They have investments in apparel. They have their own companies and brands. They have investments in philanthropy. So they got money all over the place, spread out. So that way, if any one thing blows up, they're still fine. So learn to manage money the right way. Unfortunately, at the beginning, growing a small account, you will need to concentrate like on just 1 or 2 of these bubbles. And once you concentrate on those 2 or 3 little bubbles or areas, whether it's day trading, swing trading, option trading, whatever the case is, doesn't matter. Take your pick, but just understand your concentration of risk is going to be very high. So you need to either then spread out your capital across, like let's say you're doing day trading, instead of doing day trading on 1 stock or swing trading on 1 stock, instead of doing it on 1 stock, you're going to do it on maybe 3 or 4 or 5 stocks. This way, you can at least spread your capital in different areas. So if you've got $10,000, you could spread $2,000 each. And that helps eliminate any single stock risk at any given point. It just helps eliminate that issue or problem. So anyways, the point is risk management, diversification. Think about it. Most people, they over-concentrate too much risk in a single spot. That's the end of it. That's usually the big point in summary, is that we usually concentrate way too much at any one single point. If you can find other ways in the stock market or in other parts of your life to diversify that risk, you'll be way better off. So for example, if you're doing it in the market, day trading, swing trading, option trading, which really stems into a lot of different things like iron condors, verticals, calendars, butterflies, diagonals, long-term investment, theta trades, a volatility trade. So that has a lot on its own. And then you've got dividend investing. So all that kind of stuff really can start to diversify your risk. Anyways, thanks for joining me. I hope this gives you a little tip and insight, and I will see you on the next one.